My name is Amol Nirgudkar. I'm the CEO of Patient Prism. I'm delighted to have Kevin Arnold from TUSK Partners at our studios this afternoon. And the topic, believe it or not, is accounting and financial statements and balance sheets and profit and loss statements. And so what I'm trying to understand, Kevin, is when you decide to become a DSO, do you have to make changes in your accounting, the way you account for expenses and income? Because obviously there are two types of systems, cash and accrual, and then there is obviously if you are a group of few practices, you've kind of been on cash basis.
Typically, yes.
And now you're converting. So what's the process of first is converting to an accounting system that's going to be eventually used for acquisition or sale of your practice.
Well, as you scale up, you're going to have to make that switch from cash to accrual basis or GAAP basis, because investors who are coming in are going to want to see your financials on that accrual basis or GAAP accounting.
Sure.
So the process is really, it's going to be a lot that your CPA is going to have to take care of a lot of that for you. But it will be a little more cumbersome for your bookkeeper, that accounting team. They need to make sure they're tracking things the way the CPA wants to see them so that you can see the difference in the financials. Really, day-to-day operations isn't going to change anything for you clinically in the practice. It just all comes down to how the numbers are tracked and what the CPA is doing on the back end.
But you'd still need to build a robust accounting system, right, that reports across your locations.
Yes, you need to see consistent financials across the locations. I know we want to see quarterly financials so we can actually look at your business every quarter, compare to last quarter, and also see the rolling 12 months. So we always have a good picture of your practices.
Is it a good idea to convert right away before you even get there, or can you wait till you're getting ready to sell?
You need to have a couple years of quality financials under your belt before you go to sell. That way they're looking at consistent financial results. That year you change from cash to accrual, there's going to be some adjustments and your financials are going to look a little different.
Sure.
So they're going to see at least 2 years there.
So when TUSK gets involved in kind of looking at the financials, do you guys help them understand that we recommend this consistent chart of accounts that you have to use for all your offices?
Absolutely.
And are you helping them kind of normalizing these statements to look all consistent with GAAP?
And we'll definitely recommend a chart of accounts for them, make sure they have consistent procedures across all the locations.
Sure.
When you look at your location in Tampa and your location in Sarasota, you want to know that they're being looked at and judged the same way. Expenses need to fall in the same buckets, and so you can understand how they actually compare. We'll definitely help them with that. And then that also ties into the metrics of what you look at.
Do you recommend any accounting systems, or is QuickBooks okay?
It's really whatever they're comfortable with. I don't have a favorite personally.
Okay.
Yeah.
Well, and then as you look at when you go, we talked to Walker earlier about taking a deep dive into the financials. What are you looking at in terms of what are the top three things you look at? Obviously, you look at the revenues, but from an expense standpoint, what are the 3 or 4 metrics that you really hone in on in terms of these things are important?
Right. Yeah, revenues are obviously important. We want to continue to see growth there. Really what all ties back to though is your EBITDA, which is a function of how profitable you are. So expense-wise, I guess the trouble areas I see are usually wages. Generally, wages are high. There's a lot of staffing that really needs to be reevaluated.
Sure.
Then after that, I'd say the next 2 are labs and supplies.
Sure.
As you scale up, you got to find a way to capitalize on your scale and reduce those costs, whether it's becoming more efficient, creating a formulary, negotiating lower rates with your local labs. Those are the things you got to look at and capitalize on your scale.
So one of the things you do is most dental practices will have financial statements prepared by CPAs or compiled to prepare tax returns.
Yes.
Right? But now you're moving from using financial statements just for compliance to file the stuff, but to manage your business.
Yes, that's imperative. Just looking at the numbers doesn't do anything. You have to look at them and then interpret them and then apply it to your business so that you're actually getting better results quarter after quarter.
And so when you're looking at valuation, let's skip over that a little bit from financials. Obviously, the first thing you look at is how profitable you are. You look at EBITDA.
Correct.
So what is EBITDA for people who don't know?
The actual definition, earnings before interest, taxes, depreciation, and amortization.
Sure.
Realistically, though, it's your cash flow. It's the money you have available to pay your debts in the business.
So it's your actually profit from a cash standpoint. right?
Correct.
And you add
Yeah.
back the non-cash stuff like
Yes.
depreciation, amortization.
Yes.
Are there any add backs that are even more relevant? Let's say the founders have auto expense. They have
Yes.
higher salaries than normal.
Correct.
So how do you what are the common add backs?
First thing we always look at is normalizing the owner's salary. Many times the salary the owner takes is just a discretionary number that's plugged in.
Sure.
We look to make that based on their actual clinical production as
Sure.
well as their CEO responsibilities.
Sure.
So we do give credit for that when it's there. After that, there are different one-time expenses. As you scale up, run your business like a business.
Sure.
Try to eliminate the things that are just noise in your financials. Don't pay your family members that aren't actually working there.
That's right.
Cut out the auto expense that's not related to the business.
That's right.
So run it like a business.
And obviously it helps, right, in terms of your valuation, because obviously
Yes.
those things become add backs.
Absolutely. We'll add those back. They're discretionary items. They're not going to continue with the business. So we'll make sure those are given credit. We'll include that in the adjusted EBITDA number and then go from there with that number.
At what point do you need your financial statements audited? Is it before the sale? Is it when do you engage? Because a financial
Sure.
statement audit is an expensive process.
It absolutely is. Depending on the type of sale you're going through,
Okay.
The acquirer is going to do a QOV, a quality of earnings report.
Okay.
So they're going to do their own audit.
Okay.
The audit from the operator standpoint is really up to your banking relationship
Sure.
and what kind of due diligence you feel like you need.
Okay.
Generally, when you get to the say 5 to 10 million range in senior debt,
Okay.
you're going to have to consider having an audit. And that's something we'll work with you on the lending side to make sure we try to push that as far out as possible,
Right.
because it is a costly event. Internally, if you feel like you need an audit, then obviously that's something we can talk through about the reasons why you want that. It does become necessary as you scale up and your operations get more complex,
Sure.
but it is a cost to keep in mind.
Maybe you could just convert the financial statements, I guess, once you decide to become a DSO to accrual, and then maybe get a review done. So
Yes.
that's like in the middle way.
Review is the
Right.
first step, obviously.
Review is the first step, and then when you're ready to entertain buyers, maybe think about that. Correct?
Yes, I mean you can definitely for sure. It's going to make your numbers are going to be, better if you have an audit done. They're going to be more clear, more easy to interpret, which obviously takes out some of the fuzziness that a buyer doesn't want to see.
And it's more reliable. At the end of the day,
Absolutely.
as a CPA, we've said that accounting, the purpose of GAAP financial statements is to be more reliable, and reliability means that the buyer has more trust in your numbers than if you didn't have the audit.
Absolutely, that's important.
These are great points about accounting and financial statements. As you guys think about becoming a DSO, it's important whether you're a DSO or not. I think accounting matters because understanding the numbers matters, not just from a standpoint of complying with the tax laws, but also from managing your business and looking at those key metrics becomes really relevant. So have those discussions with your CPAs and understand the components of those costs so that you can make better decisions. So thank you, Kevin. Thank you for this
Thank
wonderful
you.
discussion.
Thank you.
Thank you.